We discussed about how we have all of these indicators, right? But what are some general or common mistakes that traders do when using them?
I think probably the top one is relying too much on indicators, when what you should be doing is combining rather than relying, combining indicators with price action, with fundamentals, with sentiment, and various other factors.
And what are some of your personal mistakes from your own experience that you can recall?
I would say it's ignoring indicators, particularly saturation, but also on the other side, it's treating saturation indicators as being too serious.
Hello and welcome back to our weekly episode of Trading Talks. Last week we discussed about technical analysis and how to keep it simple. This week we're going to discuss about trading mistakes using indicators and hopefully how to avoid it. If you haven't done so already, you can like and subscribe and turn on notifications to be amongst the first to know about the next episode of Trading Talks. I am Andreas Themistokelous and together I have Michael Stark. Hello, Michael.
Hello, Andreas.
Okay, so when it comes to indicators, we discussed in earlier videos, there is a million indicators you can use. Some of them show the same thing as the next indicator, right? So what are some general mistakes that people tend to do with indicators? Is it combining indicators that show the same stuff? Is it combining indicators that shouldn't be combined? So what's your take on that?
I think it's the first one. That's one of the top mistakes of using indicators, is using lots of indicators which show you more or less the same thing is one aspect of it, because it's redundant. You're just cluttering up your chart for no reason.
Yeah.
And also I think it's when you use lots of different indicators, or even just 2 or 3 indicators, which might show you different things on the chart, but they're based on correlated sources. You know, like various different moving averages or moving averages combined with MACD in some situations. The sources are correlated and they're quite laggy usually. So that's one thing. And I think also definitely is ignoring your indicators one of the top reasons, especially if you're using oscillators based on saturation and you ignore overbought or oversold conditions. In some cases you can, which hopefully we'll discuss that later if we've got time. But I mean, in many cases you should not ignore indicator, because what's the point in putting it there if you're just going to ignore it? And I think another one is overfitting, just trying to fiddle with the settings too much and have everything very specific, which is maybe not necessarily very dangerous in terms of losing money, but I think it's just a bit of a waste of time in my experience.
Yeah. I remember in my early days, I just decided what trade I wanted and then just fiddled around and trying to find indicators that fit my hypothesis, right? Indicators show different stuff, but they do also have some limitations, right? So can you expand a little bit on that?
Well, I mean, pretty much any indicator, there's exceptions, of course, but pretty much any popular indicator, let's say, is based on one source. Like this moving average is a really simple example. It's based on the average of the price over a certain number of previous periods. So it always lags, but sometimes it really lags a lot. And there isn't really such a thing as a leading indicator, which is a technical indicator in the sense that we usually mean leading indicator. So that's one, like, I think, obvious limitation of indicators in general. Well, that's 2, actually, I suppose, limitations of indicators in general. And I think the fact is that also that even indicators that don't lag very much at all, they will inevitably take some time to react to a major event. Like if, let's say, tomorrow morning, this will not happen, but if it did happen, tomorrow morning Jerome Powell wakes up and he says, okay, screw it. I'm going to do what Donald wants. I'm going to cut all the interest rates into negative 0.5%, right? And everything is going to go totally haywire. It doesn't matter what the indicators say. Obviously, that won't happen. That's an extreme example, but there's various other lesser examples. You know?
Yeah, it would take some time for the indicators to adjust to this chaos in the market, right? Yeah, because
so I think the key lesson there is don't rely too much on indicators. I know it's very tempting to use indicators, and they are very useful, of course. You just need to combine it, I think, also with what's actually happening on the chart, the price action, fundamentals, and sentiment too.
Yeah, combining indicators but not rely completely on them. Yes. Yeah, that's the lesson there. All right. So what are some mistakes, probably from your own personal experience, that you can recall using those indicators?
Definitely, I would say it's ignoring what the indicators say. I mean, specifically, I'm thinking about using signals of saturation from Bollinger Bands and also from a slow stochastic, ignoring when it's overbought and buying anyway in overbought. That was a very common mistake when I was a newer trader. But I think also the other side of that is that in some cases, actually, you should ignore signals from saturation. I mean, because I'm thinking particularly about cryptocurrencies, for example, then they usually just don't really care very much about saturation. You just keep going in the trend, regardless how overbought or oversold it is. Most of the time anyway. And I think also within the last few years, dollar yen and actually pound yen, other pairs with the yen has been in a pretty consistent cycle over several years of losing value. So on many of these pairs with another currency as the main currency and the yen as the counter, we're seeing overbought signals, right?
Yeah.
And we can actually just ignore that in the context. Not ignore, but I mean kind of
don't rely
heavily on it.
Yeah.
And I think the lesson there is kind of like to find some sort of balance between ignoring the indicators too often and in some cases, thinking carefully about it and then just taking that signal to one side. You don't need to have all the signals agree at the same time.
Yeah, I remember back when I started trading, I just used, saturation-based indicators like the stochastic or the RSI. And I was like, okay, I will sell whenever I see overbought and then buy whenever I see oversold. That's it. That's my strategy. Why are all these people using all of these different indicators, right? I mean, this is a golden egg laying chicken, but that's not the case.
And it's not wrong. That approach is not wrong. It just needs other approaches with it as well.
It worked by like 3 out of 10 times.
Yeah.
But yeah, you need at least 5 or 6, right?
Yes.
To be profitable or break even at least. All right. So thank you very much, Michael, for providing your views.
Thank you for listening to my views.
And thank you to our viewers for watching this until the end. Hopefully you learned something today. We will see you next week. We are going to be discussing about indicators and patterns.